When change comes, opportunity abounds. We're about to enter a period of the fastest pace of technological change in all human history, something we refer to as the Exponential Age. And Real Vision is going to be your guide to this incredible future. Vince, fabulous to get you on Real Vision.
Well, it's a pleasure to be here, Raoul.
Yeah, really looking forward to this conversation. You know, to chat to somebody about technology and their journey through the markets is always fun. Let's introduce yourself, what you do now, and then we'll go back in time and how the hell did you get here?
Okay, sure. So my name is Vince Smith. I am the Chief Investment Officer at Temescal Canyon Partners. We've managed several hedge funds over the years, a multi-strategy fund that took advantage of my background in fixed income and equities. And most recently, we launched the TCP Diversified Technology Fund, which took advantage of my background in tech. And we can get into how I got out of fixed income and into technology.
Let's hear your story. How did you get into Wall Street in the beginning?
So I did an internship in 1987 in London at a place called Hitchens Harrison. And I sat on the stock exchange for 2 months during the summer and fell in love with the action of Wall Street. So when I came back to the States, I just decided I had to work on Wall Street. So I applied to all the big banks. I got a job at Morgan Stanley in the M&A department, and fortunately had a great mentor there. His name was Bill Lewis. He ultimately became the head of M&A at Morgan Stanley. He was a vice chairman at Lazard, and now sits on the management committee at Apollo. And so that's how I got my start. It was really about, the fascination I found with the financial markets, and it stems back to my initial internship. And then when I got to Morgan Stanley and worked in M&A, I remember there was a day when I opened up the Wall Street Journal, and there were 3 deals on the What's News section on the Wall Street Journal that our office was working on. It just doesn't get more exciting than that. And I was hooked.
So how did you make a move to the trading side?
So, the 2-year analyst programs for me were really supposed to be a way to get exposure to finance, but I ended up staying a 3rd year. And then once I was done with my 3rd year, I just decided that going to business school, because I had been a finance major undergrad, was just probably not the right thing for me to do. So I, sort of took a look at the financial landscape. I saw that, Drexel had just collapsed, and there looked to me to be a lot of opportunity in the fixed income market, especially in junk bonds. And I got an offer to work on the desk at Merrill Lynch that was headed by a 29-year-old kid named Tommy Gann, who's become a legend. But Tommy, appreciated my background at being able to look at credits from a more analytical and valuation perspective. And that's where he saw the market was going, and that's where it went. And for the next, 8 years I spent sitting on that desk. I became the youngest managing director on the desk. I was the number 2 salesperson on the desk. And I just decided that, it had been a fascinating experience, but my passion was technology, and the internet was starting to really take hold. This was back in 1998, and I decided to resign from Merrill Lynch, something that people thought I was a little nuts about. But I had to do it. I saw that this internet thing, I thought it was going to be big. And I left Wall Street to start a company called Be There TV. It was a technology company, a partnership I formed with Dennis Publishing. Dennis Publishing is a company that published Maxim, Stuff, and Blender magazines. At the time, Maxim was one of the hottest brands in the country. They had the top celebrity parties all the time, the most beautiful women on the cover of their magazines. And my vision was to take all of the content that they didn't even know that they were creating at photo shoots and at parties, and put samples of it, make it available online, being streaming video. And I thought millions of people would view it. And that's exactly what happened. And I became, the largest content distribution company on the internet. I licensed my content out to Windows Media, to Yahoo, Broadcast.com, Comcast, Infinity radio stations. Like all 150 of their radio stations had our content on their radio station websites. We were really big. We just were probably a little bit early. Because we just broadband didn't have quite the penetration. And the hardest thing was getting advertisers to step into, into a landscape that they weren't familiar with. They were comfortable with, running 30-second ads on television, but didn't think that it would work running advertisement in front of short form content on the internet. We showed them, we actually went on a campaign across all the ad agencies in New York to show them how it could work. And people were just slow to actually engage and adopt. And so we ended up having to sell that company to UGO.com in 2004, and they ultimately sold that combined entity to Hearst Media. And Hearst had no idea what they were doing with any of those properties, so I think they probably wound them all down. But so yeah, that was my sort of departure from Wall Street. Gave me a chance to operate a real technology company. Became really familiar with how tech works, and really the challenge for tech is understanding it, but then also understanding how to use it to sort of serve a particular use case. How to really harness the utility of the technology that's been adopted. Because at the time, we weren't pioneers in streaming video of the technology of it. The technology was built by someone else. We used the technology to create a platform that became quite popular. And that's where, I kind of see that's kind of similar to where we are now. There's a lot of technology out there that is, I think, becoming ubiquitous. And you can kind of just pull it off the shelf and use it in any way you see fit. And then it's really about how you use it and who you're able to get to engage with you that is really going to matter. I realize I'm kind of sidetracking here, but
no, we'll come into all of this.
Right.
Your career is interesting because you then go back to the investment business, right?
Yes. Yeah. We sold the company to UGO.com, and then as fate would have it, my old boss from Merrill Lynch found out that I'd sold the company. He rang me up and said, "Hey, look, I'm building a business up here in Greenwich, Connecticut called Libertas Partners. It's a broker dealer. I've got a hedge fund. Why don't you come up here and join us?" And because I'd known him for 20 years at that point, and I know the kind of guy he was, I knew that I'd have a lot of entrepreneurial flexibility. I decided to join him. And so I became a partner at Libertas. And when I got there, I was an analyst on our hedge fund, covering tech. Because I had just come from, sort of spending 4 years in technology. I was the head of investment banking, where I did a couple of deals. One was a $100 million deal in tech for a company called USLEC. I also advised USLEC on the sale itself to Paytech. I also raised about $750 million for Cliff Perlman and Quincy Jones. They were going to be the first African-American owned casino on the Vegas Strip. Quincy was going to be that guy. And I was going to use what I was saying in sort of tech to help them become like a really high-tech version of some of the other casinos that were on the Strip. They loved the idea, and I raised $750 million for it. Unfortunately and fortunately, that we hit the Great Recession, and the financing kind of went away, which was a good thing because ultimately the Riviera had to file for bankruptcy just because of what happened with the Great Recession. But then also, those are the things that I was doing at Libertas. And one of the things that I had discovered, while I was actually raising money for my tech company, is that there are billions of dollars around the country that have been earmarked to invest in businesses that are run by minorities. In a lot of cases, they can't allocate the capital because the minorities don't have the right backgrounds and the right pedigree. And I thought, okay, I've been covering hedge funds for the bulk of my career. I really understand technology in a way that a lot of hedge fund managers don't. So why don't I start my own hedge fund? And I kicked that idea around with some friends, and I got some support. One of my former clients when I was at Merrill Lynch, and he also was an investor in my tech company. He liked the idea, and we partnered up together to form Temescal Canyon Partners. And that's where I've been since, or at least working on Temescal Canyon Partners since 2011. We didn't actually launch our first fund until 2013, but we launched a fund. There was a multi-strategy fund where it was kind of a best ideas fund. And our idea, the goal was to take the best idea we can find in any company that is publicly traded or not publicly traded, but had some sort of fixed income or equity security that we could trade so that we could assess where the best risk-adjusted return in the capital structure would be. We got off to a great start with that. We had, a pretty impressive team. My partner at TCP was a guy by the name of Peter McMillan. He had been the chief investment officer at AIG Sun America, where he was managing about $70 billion. He got to a point there where he just decided that he'd rather manage money than manage people, and left and decided to do something a little different on the investment side. We had Rob Farmer, who was an African American who graduated from Harvard Business School, also founded Advent Capital in New York, which is now about 15 billion AUM. And a guy by the name of Craig Butler. He was a JD MBA from Harvard, and was a portfolio manager at Fortress. So we thought that pretty quickly we were going to be able to become a multi-billion-dollar hedge fund, and that just didn't happen.
Yeah, I know how that works.
Yeah, exactly. So, because of the nature of the setup, we were all kind of like, coming up with ideas in our own special areas of expertise. Mine were in consumer products and technology, and Correga's were in mostly energy, and the other two partners were kind of, somewhere in between. Technology, as we all know, did really well from 2013 through 2019. Energy, especially the area where one of my other partners was focused, did not. My gains in technology weren't good enough to offset his losses in energy. And so at the end of 2018, we decided to close down the multi-strategy fund and launch the TCP Diversified Technology Fund. When we did that, my first year, unfortunately, was the first thing I faced as the CIO of the organization in my first fund was the pandemic. We literally launched the fund on February 1st of 2020 or 2020. And a month later, I'm like going, oh my God, what is happening? The world's imploding. But, once the dust sort of settled, we kind of we felt like we understood what should happen given where interest rates were. Because, as an analyst at Morgan Stanley in the M&A department for 3 years, I know how to build a DCF. And I know what the key components of a DCF are. And when you take interest rates down to 50 basis points, or, even on the 10-year down, below 1%, that's going to support some pretty lofty valuations, especially in the areas of, the stock market that I invest in, i.e. tech. So I sort of understood why so much money was plowing into longer dated assets. And we were able to actually do pretty well, 2020 to beginning of 2021. My return was a little over 30%, which with lower volatility than the S&P and the NASDAQ. And we did it, sort of just, not swinging for the fences, but really just trying to take things opportunistically. We were in a lot of large cap tech names that we have been covering for years, and they all worked out pretty well.
So what is your framework for tech investing? Because different people come at this in different ways. How do you look at it? Because it's kind of strange because you come from a fixed income background, which is not normal for tech guys. But what is your framework? How do you think about tech investing?
Right. So one of the things that I forgot to mention early on was that when I was an analyst at Morgan Stanley, this is going to sound kind of funny. We were all being introduced to the PC. My very first PC at Morgan Stanley was based on 386 architecture. We thought it was really impressive when we were all allocated 486 machines. We would literally hit F9 on our computers and go out to lunch and come back, and our computers would still be calcing. I mean, that's the kind of area of technology that I came into, and we were just all fascinated by technology. So me in our bullpen, when we were not working on the companies we were supposed to be working on, we were all talking about technology because we were all fascinated with it, because we saw how it was changing what we were able to do, and we understood how it was going to really be changing the world. And so when I got to Merrill Lynch, by the time I left Merrill Lynch, my very last year, I made more money trading tech stocks in my personal account than I did with my salary and bonus. And I had a 7-figure year. So that's, really what I've been focused on for for all that time. I was, an analyst and then a fixed income salesman, but my passion was technology. So that's kind of how my mindset worked. That's why I got into it.
So how do you approach it now? So
Right.
Technology, you're investing a portfolio. What do you look for? I mean, there's a lot of tech out there. How do you figure out what to own, what not to own?
Absolutely. And that's a great question, because I think that until recently, and this is why we created the TCP Diversified Technology Fund, until recently, tech just sort of was treated as this giant monolith. It's like, oh, that's tech. But within tech, there's so many different industry subcategories. just like everything else. I mean, so within tech, there's data and analytics, there's security, there's e-commerce, now there's EV. They're definitely different. There's blockchain technology. There are different technologies within tech, and I could show you how, very differently all of those things have traded even this year, because the business outlooks are much different. You can't just buy tech thinking that it'll all trade the same, because it won't. And understanding those different categories will allow you to sort of shift from one area of, sort of potential outperformance to another. Like, for instance, back in, 2015, 16, maybe getting my dates, sort of confused a little bit, but it was in the mid-teens when we were trying to play the cloud because we understood the rapid adoption of the cloud and why it was happening, but we didn't necessarily want to pay 30 times revenues for some of the companies we were seeing. So rather than play in some of the higher priced software opportunities, we played in some of the lower multiple opportunities as more of opportunistic trade. So I bought Micron at 10, it went to 60. We were buying Seagate Technology in the teens, it went to 70. We bought, Western Digital at 15, it went to over 100. But those companies were indirect beneficiaries of the cloud deployment. We understood it, so we were able to take advantage of that. And similarly, in other sectors of the market, Amazon, for instance, is e-commerce, but we also understood the business and what they were doing with AWS, because we saw it as, I remember, buddies of mine thinking, wow, it would have been so great if AWS would have been around when we were deploying be there, because they had so many great, sort of tools for people that were building or needed tools to build on a platform who were building out technology assets. And so, some of the biggest, best known names today were fledgling back then, but they were built on AWS, and we understood that.
Why is it that so many people misunderstand technology investing? They always think it's total boom bust. I see it as adoption curve. So over time, it goes bottom left to top right, but it's volatile within because of the macro. Why do people misunderstand that? They kind of, it's weird. People get really emotional about it. They like it's an oil company or something that's more cyclical. Why is that?
That's a great question. One of the frustrating things for me over time has been how people try to use traditional metrics to buy technology companies. For instance, I remember people back in I guess it had probably been like 2001, 2002, when Amazon was trading down at the equivalent of, it's split many times now. So it has split, so I don't know the exact price. But, it was trading at about 99% lower than where it is today. And people thought it was, overvalued because of a metric.
I remember that. It was trading at a P of 800 for quite a long time, 6 years.
Exactly.
And because none of us understood what it was,
right,
we were like, this is crazy. This is worth more than all the other booksellers in the world added together. And then it was worth more than Walmart, and we didn't get it.
Exactly. Yeah, I think a lot of traditional investors just don't understand how transformative some of the technologies can be. And so when you try to, and I came from fixed income where, buying a company that was trading at 6 times EBITDA was expensive. And forget about a company that didn't have positive EBITDA, So there's definitely a different sort of valuation framework that you have to use. And I don't think that, it's been adopted by all investors. I mean, for instance, one of my heroes, Leon Cooperman, admitted that he missed out on a lot of great opportunities back in the early days of Web 2 because he ignored companies like Google. He ignored companies like Facebook. But his sons, they actually understood it and forced him to get into some of those opportunities, and they worked out. But I think people are just, they're comfortable with what they know, and they're comfortable with how they've been doing business for many, many years.
People just dismiss it also. I find it really interesting is, it's just a function of cheap money.
Mm.
So,
right.
They're like, oh, well, Vince, he's had a great career. He just made money because the Federal Reserve kept cheap money and none of this would have happened otherwise. And I'm like, yeah, but the technology goes on relentlessly. Right. It doesn't stop. But how does cheap money work into your framework? How do you think about it now, which is complicated, right?
Well, yeah, no. So now I think it's a really interesting time to be investing in tech because you really have to see past the fact that, the cheap money is gone. So now it's like, let's not focus on, being able to borrow at less than 1%. And let's leave the financing side out of it for a second, because traditionally most tech companies don't even have debt. It's really just what your relative opportunities are. Should I invest in, a 4% risk-free return, or should I take, a little bit more risk and invest in, something like the NASDAQ, where I could expect to get on average somewhere in the mid-teens. And that calculus is changing because of where we're coming from. The valuations in the NASDAQ can still probably come down a considerable amount. But over time, I think that what you really want to be doing is understanding these businesses and understanding what impact is 4%, a 4% risk-free return rate going to have on the long-term ability for this business to generate free cash flow. And so if you would have looked at Oracle Systems, for instance, is a company that I own. I literally plowed my entire second year bonus into Oracle Systems back in 1991 at 15. It immediately went to 7. But then it went from 7. It went from 7 to 5,000 or something like that. But back then the risk-free rate was 6%. But so it really didn't matter where interest rates were. What mattered was you had to understand the transformative effect of the technology that was being deployed. And I think that's what people should be doing now.
My view on this is, if these companies are fast growing, then a 4% hurdle rate is nothing, because it just needs to compound more than 4% and you're going to make money. So it kind of misses the point that these aren't static. This is not the Austrian 100-year government bond.
That's right.
These things aren't static. So they have business models that expand over time. And if they continue to grow, even if it's in line with bond yields, you'd rather have the growth of the equity upside than the risk-free rate.
Absolutely. And that's one of the things, like one of the areas of the market that was super hot last year, at least, in the private markets, Web3 or basically blockchain technologies, I've never seen an asset class shunned more. But I actually think that it's very similar to what we saw back in, the early 2000s. When if you mentioned .com anything, people would show you the door because they had just had it with .com. But you think about all the great companies that were created in that era. Google, Amazon, Apple actually had a tremendous amount of growth from that period of time, and largely because of what's happened with the internet. So people tend to throw out really good companies because of a technical market sell-off, which basically creates a tremendous amount of opportunity for guys like us who are willing to roll up their sleeves and really try to understand what the businesses do and what the long-term fundamental outlook for those businesses and their ability to actually generate cash flow are going to be.
The one stock in the Web3 space that looks pretty obvious on that kind of metric is Coinbase. It's like it came out, got absolutely smashed. I don't know what it's down, 90% kind of. And basically, they're one of the large gatekeepers to the whole Web3 world. And you kind of, I just look at those things and think, okay, this gets really interesting to me. Obviously, I love crypto in general, but in a stock world, there's a lot of stuff that got absolutely smashed. And my spidey sense is up thinking, same with a lot of the growth technology as well. Anything that's down 80% goes on my screen as I need to watch this.
Absolutely. I agree with you. And again, we saw the same thing happen back in the early 2000s. There are going to be some massive winners that come out of this downturn, because some of the companies, that I've seen, are down 70, 80, 90%. I can see how they actually have real businesses, and they're going to be in great shape once we actually get into, a period of more economic and fiscal and financial, certainty. Right now, we have no idea what's going to happen with rates. We have no idea what's happening with global economies. They all seem pretty much poised to be set up for a significant slowdown. We have no idea how that's going to impact even quickly growing companies. Like, one of the companies that I follow in the used car space is called Vroom. It's its closest comparable is Carvana. They're both, they both sell used cars, and with interest rates coming down considerably, but with the economy actually staying pretty strong, the difference in revenue for the quarters, for the last quarters that they just experienced, was significant. They missed revenues by 20%, and that's with the economy actually growing. So you're going to see that in different sectors. Not everything in tech is going to perform the same. Spikes in interest rates are going to impact, different sectors of technology in a different way. Housing is getting crushed right now. And you're seeing, companies like Zillow and Redfin. They're not trading they're trading very poorly. Those are the companies that longer term, I think they've got great business models. I think everybody born, in Gen Z, they'll all go to Zillow or companies like Redfin to look for a new home. My family bought a home, during the course of the pandemic, and we spent hours on both of those platforms and found them invaluable. So I think that's the way that people will be, sort of buying homes in the future. And a lot of those types of technologies that really kind of gained a foothold over the last several years, those businesses are actually ultimately, I think, are going to be successful.
Because they're not so speculative because they've already got established business models.
Yes, exactly.
But they're being thrown out. The baby's being thrown out with the bathwater right now as everything gets smashed down.
Exactly. I mean, some of them may never, or it may take them years to get back to their old prices. But here's a company like Zillow, for instance. It ticked up at over 200 in the first quarter of 2021, and now it's trading at 29. Was the market that wrong? Was there that much exuberance? Probably. But when I get back to looking at something like a Zillow, and I look at historical growth models under different levels of interest rate, what scenarios interest rates are sort of normal, then I can actually probably start to justify value for Zillow probably a little bit higher, quite a bit higher than where it is now, even if interest rates stay at this level for years, just because the underlying growth in the business. I think that it'll continue to grow. And then I think there are a lot of names out there like that. Like another is Shopify. I mean, Shopify.
Yeah, that's been killed.
Yeah, I mean, I'm looking at this chart here. Shopify traded over 160. It's at 30. It probably went up a little too high, obviously. But Shopify is a staunch competitor in e-commerce. It just makes sense. I think they actually also will have a tremendous opportunity to be one of the significant e-commerce or Web3 participants because they're allowing their customers to take various cryptocurrencies. And I think a lot of those, a company that is of their size that understands tech and its deployment and the importance of Web3, I think they'll have a chance to make some significant inroads on some of their larger competitors that, have been a little bit slow to adopt, sort of blockchain technologies. Like, where's Amazon in blockchain today? I don't know. They haven't announced anything publicly, but Spotify has.
Yeah, and I've spoken to quite a few. Facebook obviously has, a whole bunch of people have, and it's getting really interesting. One of the things I looked at with technology is I'm looking forwards and I'm using Metcalfes Law, so adoption models, network adoption models, and I sit there and look at all the technologies that are going up the adoption curve. So these are not future technologies, but we're talking about AI. We've seen what's going on with GPT-3 and DALL-E and OpenAI and all of this stuff. We're seeing EV, we're seeing Internet of Things, we're seeing blockchain, we're seeing space, we're seeing robotics. All of these things, genetic sciences, all of these things are coming at the same time. And my view, I call it the exponential age. It feels like it's going to be the fastest pace of technological adoption the world has ever seen or humanity's ever seen.
Yeah, no, I agree with you. I remember reading a piece about the adoption of technology and the deployment of technology back in 2016, and it really just inspired me because it talked about how all these different technologies that have taken 20 or so years to get to this point, they're all poised to take off at the same time. We've now got the power of compute using things like GPUs, which NVIDIA has developed. I mean, I've been invested in, well, I was invested in NVIDIA 7 years ago and rode it for 6 years. We got out of it earlier this year. But all these things are coming together. And so the interesting thing is you have to be in a position to understand the impact on all these things sort of taking hold at the same time, because they're not going to be good for everyone. I think they'll be great for the consumer. I think they'll be good for the businesses that get it right. But for the businesses that are slow to adopt, a lot of businesses are going to be destroyed by this rapid deployment of technology because they were slow to act. And we saw it happen with the development of Web 2. and the deployment of Web 2. There were a lot of businesses that were really slow to react. I mean, just off the top of my head, the newspaper businesses, for instance, they were really slow to just understand what all of this, immediate ability to publish.
And the retailers, they didn't realize that real estate on the internet cost nothing. Physical real estate cost a fortune, and everything changed.
One of the great examples that I've seen recently, I bet you're familiar with it, is sort of the emergence of a company out of China called Shein or Shine. They basically sell trendy merchandise. They get a lot of ideas from influencers, but the time that it takes them to go from what's hot in the street, so to speak, to having a product available that they can sell to all the TikTok users that the TikTok has is lightning fast. And they've gone from zero in revenue a few years ago to, I think they're going to do 40 billion. It's the fastest growing retailer in history. And Pinduoduo just launched a competing product. This is another Chinese company that became the #1 downloaded e-commerce app on the Apple App Store and the Play Store within 3 weeks. That's how quickly, and basically what these companies do, these platforms do, is they use AI to interact with social media platforms, and they handle supply chain, and they use AI to predict trends. I mean, it's all coming together. And then, if you look at the companies that have negatively been impacted by this new rapid deployment of e-commerce using this new strategy, they're all American stores. Walmart is getting crushed. They had to slash inventory on sort of clothing for young people dramatically because they can't sell it. And same with Kohl's and several other U.S.-based retailers. They're feeling the brunt of the pain because they have been slow to adopt. And I think there are going to just be a lot more companies that roll out that kind of technology, just using technology in a different way that don't have the bureaucracy of a lot of the, sort of the incumbent large retailers here in the United States.
What are you seeing in AR and VR, which is another one of these mega trends that's happening?
Yeah, no, I feel like the landscape there is still very fragmented. I don't think anybody really has a lead. I think the leaders in the space are really going to be companies like Epic Games, who have Fortnite, or my buddy, the guy who I actually sold my tech company to, Be There TV, is now on the board of Take-Two Interactive, and I've spoken to him, and they've got some plans to really engage the audience that they already have in ways that people aren't really thinking of now. But it'll be based on it'll be easy for them to sort of get their audiences to want to really step into an artificial environment. Or sort of a virtual environment, because they're already somewhat doing it. So I think the leaders in AR and VR, in my opinion, because they just already have such massive audiences, and they have sort of the next generation of audiences. Like, for instance, my son plays Epic Games Fortnite every day. He's 12. And he hasn't even started playing Grand Theft Auto yet. But I have friends in their 30s and 40s that still play Grand Theft Auto. So they've got kind of a pretty good audience base from which to grow those products. So I think if you're looking to be in that space, launching with one of those platforms makes a lot of sense. And also Roblox, for instance, I think Roblox is going to be a significant player in both the AR and VR. They've already got a very large user base. Again, my kids use it all the time. Gen Z is all about adopting technology, and they adopt it quickly. I'm just amazed. And how quickly they are willing to take a look at a new technology, and if it gives them, some sort of utility, they'll use it, no questions asked. And they don't have sort of, we were all brought up to think, oh, if I've used this brand, I should use it forever. I mean, I've been using Mitchum deodorant, for instance, since I was, I was in
for no reason.
Oh, for no reason, just that's my brand, so I just go and I get it. I'm brainwashed. But that's not how these kids are these days. They'll switch around and whatever their favorite influencer is saying, but they don't have that same sort of brand loyalty. And I think companies are going to really have to work hard to establish that. But yeah, I mean, AR and VR, I think the gaming guys really have a good lead in terms of being able to get people to adopt it. I'm not so sure how people are really sort of gravitating toward Facebook's solution. There's just so much negativity around Facebook. And I kind of get it. I mean, it became it went from being a great place where I enjoyed actually logging on to have see what my disparate friends were up to a place that just became bitter and just so much vitriol and hate and anger. It's like I don't want to be there anymore.
No, exactly right. So a lot of the big tech investors, whether it's Tiger Global guys or a whole bunch of them, are massively in cash right now, and everybody's waiting for the macro to resolve.
Yep.
So let's assume the macro resolves over the next year. Where do you want to deploy capital? What really excites you outside of some of the consumer plays you've talked about now? But when you're thinking, this is going to be the next big thing, these are the big areas I want to get involved in, where do you really want to deploy, you think?
Right, so that's a great question, and we've kind of been, sort of doing that. We've kind of been formulating that list of companies over the last, 9 months or so. But I think that the companies, from my perspective, that I want to be involved in are not necessarily sort of the startup companies or the companies that may have, sort of raised some capital at the peak of insanity back in 2021 that maybe have a business plan, maybe they don't. But I want to invest around certain themes, a lot of which you've mentioned. I want to be in companies that are leaders in AR and VR. I want to invest in companies that are leaders in machine learning and artificial intelligence. I want to invest in companies that are embracing renewable energy because I think that the massive transition from internal combustion engine to electric it's inevitable, is going to happen. And the valuations have come down considerably in a lot of the leading companies around the world in that space. That's kind of how we look at it. I think biotech is going to be tremendously interesting. I'm not an expert there, and so we use outside consultants there. But I think, but those names have been crushed, just like the rest of tech names. But I think there's going to be a lot of innovation in that space over the next 10 years. So it's really about finding companies that have been, sort of thrown out with everything else in this massive sort of, sell-off, and trying to invest in those companies around certain themes. So like, for me, I like Roblox. I think that's going to be one that does really well. I think in the EV space, there are a couple of companies in China that can probably do well, not only because of the rollout of EVs in China, but because of the protectionism that is going on around that space in China.
And what about big tech, existing big tech, the Apples, Alphabets, Facebook, stuff like that? Where do you stand on those? Because they're not standing still. From what I hear, Apple's got huge stuff going on in AR. Obviously, Facebook's taken the big pivot, changed its name, and who knows whether they succeed or not. I don't want to bet against Mark Zuckerberg, however, and we know that Alphabet's got a gazillion different things from autonomous driving to DeepMind. I mean, I wouldn't bet against these giant companies not getting even more giant.
I agree with you, and one of the themes that we had coming into 2019 was that the big guys were just going to get bigger quickly because they had a lead in the things that we were talking about. Like, some of the best minds in terms of AI development are at Facebook, at Google, at Apple. They're all pioneering this technology because they have the resources to do it. You'll get some guys that go out independent and do things on the fringe, but these guys have been in those areas of the market for years. The one company of sort of the FANG names, if you will, that I worry about is Facebook. And the reason is, they were able to be opportunistic about pooling an audience. They were the only option available at the time in social media that was able to scale up pretty quickly. They weren't the first. I mean, most don't realize this, but there was an app called Friendster before there was a Facebook. MySpace was before Facebook. Facebook had a superior marketing plan, and then they came at just the right time when web adoption was exploding, and that's why they are where they are today. And they've obviously got some brilliant people working there. But one of the things that I noticed, is that Web3 is changing business models. Think about how much time people spend on the internet now, on these different properties, and sort of what is our benefit other than the utility of being able to connect with friends, etc. There really is none, but there could be a financial reward system. where it's sort of, basically you can earn to engage in some of these platforms. A perfect example is, what is sort of the take rate from the ordinary person that uses Facebook? I've not made a dime from using Facebook ever. But what if the model changes? And so the people, like me in my early days when I was actually putting thoughtful articles or thoughtful posts up on Facebook and there was a tremendous amount of engagement, what if I was actually to earn something for, spending the time to create those posts and develop those audiences? I think that's coming.
Yeah, we're seeing Reddit do that already.
Right. Yes, exactly. And I think it's going to come in a much bigger way. I think maybe a Facebook can't afford to just sort of drop its existing business model, right? But a new player could ultimately, and this is one of the really interesting things about Web3 that I think is coming, and it's really about the monetization of your own identity. In Web2, we let Facebook and Google and others monetize our identities. In Web3, I think you'll have the potential to monetize yourself because you can actually, create through, and I think the wallet will be the gateway to everything. Your wallet, online wallet, will have who you are, where you work, what you do, who your friends are, your social status in life. All those things can be monitored with a Web3 wallet via NFTs and other devices.
Where you give it permissioning and stuff like that.
Exactly. You people will pay you for you to give them access to your data, and as opposed to giving it to Mark Zuckerberg at all. And I think that's going to be, one of the killer apps. It's basically social networks that are created to give users and creators on the platform a piece of the economic pie, which to date they haven't really received a lot of, or it's been, sort of pretty unfair. Like, we saw YouTube just announced that it's going to start giving, I think, 40% of its revenue take to the creators on the platform. So they're still taking a pretty healthy 60%. And we know that the technology has actually become cheaper. Like you could actually, build out the equivalent of YouTube because there's not a lot in terms of, sort of earth-shattering technology used at YouTube. Sure, they've got some great algorithms, but they can be recreated because it's just code. Nothing super proprietary there. But I could create a new streaming video network that actually gives the creators 60% of the revenue that is generated by views on, their own content. And I think that would incentivize people to actually join that platform. And also I could get people who watch the content. Like, think about it. It's valuable to the advertiser for you to sit there and watch that content.
Yeah, the advertiser might as well pay you some of it and not all of it to Facebook.
Exactly. Absolutely. So I think that kind of changes the game for these ad sort of sponsored models. Because all of a sudden, I get paid my time is worth something to those advertisers. Right now, my time is being monetized, but it's being monetized by Google and Facebook.
I kind of think that people like Zuckerberg are not stupid, and the guys who run YouTube, because Zuckerberg has 3 billion people on the various Meta properties, and I'm sure he can see where this is going. And all I think of is I watch Facebook getting sold off, and I'm thinking, yeah, but what is the value of this network if it turns to Web3? It's probably twice what it was at peak. It's kind of like, if they make the right move, it's kind of priced that they're not going to make the right move. But if they can get out their own way and embrace an open Web3 and an open metaverse, they stand a pretty decent chance.
Yeah, no, there's absolutely no question that having aggregated 3 billion people onto a platform has some value. The question is just, how do they do it? And can they motivate me, Vince Smith, who spent the last 9-10 years on Facebook? Can he prevent me from moving to another platform and using that because that platform is paying me, and I know that Facebook is not going to pay me?
Well, maybe they will, is my view. I kind of think the power of technology is so big. You either disrupt yourself or get disrupted, which is what you talk about.
That's a great point. And so I think that if Facebook were announced tomorrow that they were going to start paying their users and they were going to cut them in for a piece of the ad revenue, I think the stock would get crushed. Because all of it, the short-sighted Wall Street people will just say, oh, okay, we're going to have to haircut earnings. And it's not like they're going to be able to grow the number of users from where they are today to too much bigger. So all of a sudden, you've got lower profit margins because you got to cut in. So it may be that it's temporary, And that may create a buying opportunity. But if they did that, I agree with you. Over the long term, I think they all but set themselves up to be the dominant social media platform. But it will take some short-term pain to get there.
So if you want to invest in Web3 and listed companies, what's available? There's not a lot, right? There's a few miners and there's Coinbase and stuff. What do you look at?
Well, that's interesting. That's a part of my story that I didn't quite get to. Last year we decided that we were going to close down our diversified technology fund because my partner, who's a guy who's in his 70s, and he had actually shorted GameStop and AMC in January of 2021. AMC at 2,
Right.
GameStop in the teens, and it went over 600. And that volatility in tech sort of soured him on it. And then he just saw how volatile the market was. And he decided to step away from tech. And he gave us the heads up that he wanted to pull out. And rather than, try to raise another fund immediately, because of what I was seeing in Web3, I decided to roll up my sleeves and put on my startup hat, similar to what I'd done, in the early 2000s with Be There. And I got involved with a company that they asked me to be an advisor in mid-2021, and by the end of 2021, they asked me to come on as the COO. But it's a Web3 platform. And so I spent a lot of time, understanding Web3. And you're right, there's just not a lot of plays that are public right now in Web3. And so if you want to kind of play it, Coinbase is making a lot of investments in Web3. Company called like Salesforce, they're making a lot of investments in Web3 companies. So I think at this point, one of the few ways to play Web3 is to really kind of do it through, if you're looking to play publicly traded, is to play it through companies who are making smart investments in Web3 companies that are sort of smaller companies that haven't become household names yet.
I think Google Ventures is the majority of their portfolio is now Web3.
Oh, that makes sense. I saw somewhere the other day, I wish I don't remember where I saw it, but there was, I think it was on LinkedIn, there was a list of, I think probably 50, 75 companies of, big companies we've all heard of that had made significant Web3 investments, and Google, obviously at the very top of that chart. But I don't think there was any large company that I don't know that wasn't there. They're all, doing exactly what you said. They're not idiots. They're all smart guys, and they're trying to do it very, very intelligently, very selectively, because it's going to be hard for any of these large companies to let a, sort of a cutting edge tech company get to any sort of critical mass and then try to buy it, because they'll get hit with antitrust. So I think they're doing it kind of the only way they can, which is to take small strategic investments in some of these smaller companies when they're at this level where it's really like, it's VC financing.
In summary, are you more excited about Web3 than all the other areas of tech? Or is it just one of the areas that is really interesting to you?
I would say because, I'm a hedge fund manager, I have a more balanced approach. I don't like to put all my eggs in one basket. I'd say I'm really excited to see what happens with Web3, but I think there are going to be some tremendous opportunities that'll be superior to Web3 opportunities on a risk-adjusted basis that are going to come out of the sell-off that's happening in tech.
Yeah, but I bet your PO portfolio is mainly in Web3.
my heart is in Web3. But and sort of my sweat equity is in Web3, but I feel like there's too much risk, and ultimately there could be significant return, but I'm looking for a return on my capital in addition to return of capital, and a lot of investments that I've seen that have been made in Web3 over the last 12 months, the capital hasn't come back, and in some instances I don't see it having a chance to come back to the investors that made those investments.
Vince, listen, fantastic conversation. Really enjoyed chatting to you. And
that's been great.
Let's see how this all plays out going forwards.
Okay, that sounds
we
good.
need to get rid of this macro before it becomes,
Yes.
Otherwise it's a pretty tricky environment for tech. But then after
Agreed.
that, let's see from there. There's a whole group of people who don't think interest rates ever go down again. Really, for me, it doesn't matter. It's the rate of change that matters the most. So even if they hold them at 4%, which is what the Fed have been talking about, which I don't believe, I think that's fine, because as you said, as long as the businesses are growing faster than 4%, you might as well own the business.
Absolutely. Oracle Systems was the interest rate when they went public was 6, the 2 years. So I mean, it's okay. 4%'s okay. These businesses can do just fine.
Brilliant. All right, my friend. Great to see you. Thanks
Okay.
so much.
You too. All right. Take care, Raoul.